Welcome to the GSMC Financial News Podcast, the show that delves into the ups and downs of the stock market, changes in the economy, and news from the worlds of real estate and technology. From breaking news on the New York Stock Exchange, NASDAQ, or the overseas market, to updates on the bond market, if there's money to be made, we've got you covered.
Hello. Welcome to the GSMC Financial News Podcast, brought to you by the GSMC Podcast Network. I'm your host, Virginia Lucci, coming at you from Alabama's River Region, Montgomery, Alabama. I'm pretty excited about today's show. As always, I'm going to start off with the word on the street and take a broad view of what it's looking like is going to be a crazy week. Then I want to look at stock splits, what they are, and who's doing them and why. Finally, I'd like to end the show with a deep dive on the U.S.-China trade deal. It impacts all of us on a daily basis, so I'd like to understand it a little bit more. And then this episode's top 10 is going to explore the most iconic American companies that are owned by Chinese conglomerates. Before I go any further, as always, I am going to give you my normal disclaimer. I'm not providing legal, financial, or tax advice. The show is for entertainment purposes only. So don't come at me if something happens and it's contrary to what we've discussed. The economy is ever changing, so we don't know what's going to happen tomorrow. As always, if you have questions, please visit an attorney, financial advisor, or tax professional, and they'll be able to give you advice tailored to your needs. So let's get to it. On Monday, the Dow opened to quite a few changes. We have some new faces that started on Monday. Salesforce.com replaced ExxonMobil Corp. Amgen Inc. replaced Pfizer. And Honeywell International replaced Raytheon Technologies Corp. Other than the few changes in the names that we've had, there's a little bit more of a change that we're going to see. And that's the so-called divisor, the figure that's used to determine the influence of any of the 30 components that make up the price-weighted Dow Industrials. And this is its first change since April of 2019. The move, at least, is partly precipitated by Apple's fifth stock split in its 40 years as a publicly traded company. Apple's 4-for-1 stock split set off a cascade of changes by the owners of the blue chip benchmark. So again, these are all just kind of words. So what does that actually mean? Because the value of the Dow is determined by calculating the sum of the prices of its components using a divisor that also factors when a company splits its shares, S&P Dow Jones indices felt compelled to adjust the makeup of the benchmark. Stock splits can swing the balance of influence for any one blue chip component. The new divisor is likely to be 0.152 from around 0.147, Howard Silverblatt, senior index analyst at S&P Dow Jones Indices, told MarketWatch. In other words, a $1 price move in any Dow component translates to a swing of 6.59 points from around 6.8 points. Stocks were mixed on the last day of trading in the last trading day in August, as the NASDAQ hit a new high, but the Dow Jones Industrial Average fell over 200 points. Apple's stock split also may have provided an opportunity for the Dow's managers to readjust the 124-year equity gauge to better reflect the rapid rise of technology in the broader market in the face of COVID-19 pandemic. Apple's split shrinks the weighting of formerly the most important Dow member to 3% from around 12%, and the overall technology representation in the index to around 20% from 27%. The addition of Salesforce to the Dow will bring the share of the tech in the index to about 23%. So, it's an overall reduction. The S&P Dow indices explain the overall thinking of altering the divisor as significant in the index's ability to provide a continuous measure of market valuation when faced with changes to the stocks included in the index. Apple will be ranked 18th in price on the Dow on a split-adjusted basis, while the new entrants in the Dow will be all within the top 10, led by Salesforce.com at number 3. All the interest in moves within the Dow Industrials may be surprising to some on Wall Street. More than $11 trillion is indexed to the S&P 500, while around $32 billion was indexed to the Dow as of the end of 2019, according to S&P Dow Jones indices. The Dow Jones Industrial fell 0.8%, and the S&P 500 gave up 0.1%, while the NASDAQ rose 0.6% in the stock market on Monday. Small caps traded by the Russell 2000 sank 0.9%. Volume was mixed, lower on the New York Stock Exchange and higher in the NASDAQ versus the same time on Friday. Despite some recent volatility, though, the U.S. stock market has reached new highs. A resurgence in tech stocks has lifted the tech-heavy NASDAQ to a 30% year-to-date gain, while the S&P 500 is up 9% and the Dow Jones was flat through Friday's close. The Russell 2000 was 5% underwater. For the month, the NASDAQ is on track for a 9.5% surge, the Dow Jones Index a 7.7% jump, and the S&P a 7.2% advance. The NASDAQ and the S&P 500 are at fresh all-time highs. The S&P 500 posted 11 moves of more than 1% in 22 trading sessions for August. Those moves included 3 declines of at least 2.6%, as well as the index's worst day of the year on August 5th. The SIBO Volatility Index, VIX, widely considered to be the best fear gauge on Wall Street, traded as high as 24.81 in August before pulling back to around 18. The choppy trading action this month was driven primarily by 2 factors: an escalation in the U.S.-China trade relations and a recession signal being flashed by the bond market. As trade tensions are expected to persist and bonds keep pointing towards a recession, the market's volatile streak is expected to persist. It's not just normal volatility. You've had this spike in these all-or-nothing trading days, according to Willie Delwich, an investment strategist at Baird. Whether or not this continues, from a headline perspective, I don't see a reason why it doesn't. So, what happened this month to get us into what I would call a rocky road? August began with President Trump announcing in a tweet that an additional 10% tariff will be placed on $300 billion in Chinese imports starting September 1st. The announcement wiped out a gain of more than 1% for the S&P 500 that day. The index finished the August 1st session down 0.9%. On August 5th, Trump accused China of manipulating its currency after the yen fell to levels not seen in more than 10 years. The S&P 500 dropped nearly 3% that day. According to Maris Ogg, president at Tower Bridge Advisors, Trump likes to be the tough guy. If history is any guide, he's going to go forward and be the tough guy. She continued, "I would be surprised if we made any headway," referring to the trade talks. "My guess is the Chinese don't want him as president, so they're going to make it very difficult for him." So then stocks tried to stabilize after the sharp decline after the U.S. said it would delay some tariffs on certain goods from China. However, the upbeat sentiment in the market was short-lived as 10-year Treasury yield fell below its 2-year counterpart. This is known as a yield curve inversion, and experts don't like it because it has preceded recessionary periods in the past. So the indications are not good. The 2-10 yield curve first inverted on an intraday basis on August 14th, leading investors to dump stocks in favor of long-term U.S. debt and other traditional safe havens such as gold and silver. The Dow Jones Industrial Average plummeted. The yield curve will need to begin to steepen again, led by a rise in longer maturity yields to send a more positive long-term signal for the economy and stocks, according to Tom Sae, founder of the Stevens Report, in a note. Trade tensions then escalated again last week after China unveiled new tariffs on $75 billion worth of U.S. products. Trump responded by ordering U.S. companies to move operations out of China and announced higher tariffs on a slew of Chinese goods. Equities rebounded sharply in the last week of the month as both countries softened their rhetoric on trade. The Chinese Foreign Ministry reportedly said Friday that negotiators from both countries are maintaining what they call effective communication, while Trump said some trade discussions are happening. Overall, big picture, the S&P 500 lost nearly 2% in August and logged its worst monthly performance since May when it dropped 6.6%. So there were lots of losers in August. There were a few winners. The energy and financial sectors were the worst performers in the S&P 500 in August. For the month, they fell 8.7% and 5.1% respectively, as the trade war and the inverted yield curve dampened the expectations for global growth. Concho Resources was the biggest decliner among energy stocks, losing a quarter of its value in August. Ouch, that's gotta hurt. Schlumberger and Devon Energy dropped around 20%. Yikes. Among the big banks, Bank of America was the biggest loser, falling around 10%. Citigroup, JP Morgan Chase, and Wells Fargo also dropped at least 3.8% for the month. Technology stocks actually suffered as the sector lost 1.7%. Stocks such as Skyworks Solutions slid more than 11% for the month. Overall, 8 of the 11 S&P 500 sectors fell for the month of August. But like I said, we've got some big winners. And these are your traditional safe havens like gold, silver, and long-duration bonds. The SPDR Gold Trust gained more than 7% in that time period, while the iShares Silver Trust jumped more than 12%. The iShares 20-plus year Treasury Bond ETF also rose 10.8% in August. Gold futures did incline higher on Monday as the U.S. dollar weakened slightly, but prices still looked and lower for the month in the wake of the conservative monthly gains. Overall, bullion continues to be viewed as a haven in the face of the COVID-19 pandemic, and the precious metal drew increased attention last week after the Federal Reserve said it is shifting to a policy of average inflation targeting, which would effectively see policymakers end the practice of preemptively hiking interest rates to stave off inflation. The setup is viewed as a bullish one for gold, which is viewed as a hedge against rising inflation. I've probably said this in prior podcasts, but right now, I think all indicators are pointing towards gold. Even Warren Buffett has changed his stance on gold. So I'm going to keep an eye on this story, and I'll give you updates as it continues. Gold will continue to be one of the best beneficiaries of the dollar's weaknesses. So expect to see rates or a retest above $2,000 in the upcoming weeks. That is the opinion of Hussein Syed, a chief market strategist at FXTM. On Monday, he indicated that investors are deferring to a slowing in the pace of growth improvement and the U.S. election uncertainty coming into keen focus as the reason to own gold and remain short on the dollar. I suspect this week's jobs data could be a lively affair. So we're going to get those jobs reports on Friday. I probably will record my next podcast before the jobs report comes out, but just be looking for that and let's see where it's heading. As far as stocks are concerned, for the whole month of September, investors are really hoping that the turn of the calendar will kind of ease up on some of this volatility. And hopefully that's going to happen. Since 1950, September has been the worst month on average for the S&P 500. Data from the Stock Traders Almanac shows the S&P 500 averages a loss of 0.5% in September. It will be more of a strap in than exhale and expect something to change. So let's keep our eyes on what's going on and let's figure out the best way we can make money. So we're going to take a deep breath and a quick break. When I come back, we're going to talk about stock splits. And stick around for the end of the show when I will blow your mind with 10 of the most iconic American companies that are owned by Chinese conglomerates. Stay tuned.
Are you a business owner? Someone interested in the latest news that might affect your business? Then check out the GSMC Business News Podcast, a show dedicated to keeping you up to date on all things concerning business, technology, and the stock market. Get a head start on the day as we keep you updated on the latest goings-on Wall Street, money, jobs, and technology. The GSMC Business News Podcast has you covered.
All right, welcome back. In our last segment, we took a wide view of the markets, what we've been through in the last month and what we have to look forward to in September. And I think the key takeaway from that is we really don't know what's going to happen. So, wish I had some better analysis for you, but we don't. So I want to take a look at something that's been happening on Wall Street and to very specific cases of stock splits. It seems like the thing that companies are doing these days. So Apple and Tesla were top gainers in the NASDAQ 100 after the stock splits for both firms took effect on Monday. Tesla split its shares 5-for-1, while Apple split 4-for-1. Apple and Tesla are leaderboard stocks. If luring a broader constituency of mom-and-pop investors to their shares was the motive behind the stock, it's working, at least today. Already plumped up by giant rallies in 2020, both stocks popped again Monday, each touching intraday records after the corporate actions took effect. While splits don't really change a company's underlying economics or its intrinsic value, investors took them as an occasion to do what they have almost always done this year, and that's buy, adding more than $100 billion combined to their market values. The share prices of both companies have soared in recent months, with Tesla advancing 474% this year and Apple adding 76%. Apple is now the only publicly listed U.S. company with a market capitalization over $2 trillion, while Tesla, an electric vehicle maker that aims to deliver just about 500,000 cars this year, has overtaken major corporations such as Walmart, Visa, and Johnson & Johnson. Tesla's current valuation is about $448 billion, while General Motors, which delivered 2.9 million vehicles in the U.S. in 2019, is worth about $42.7 billion. So, yeah. We believe that the stock split decision was a smart move by Tesla and its board, given the parabolic move in shares over the past 6 months, with another stock split by Apple, and likely other larger tech stalwarts will follow the same path over the coming months, in our opinion, according to Wedbush analyst Dan Ives. After closing north of $2,000 Friday, Tesla shares surged to almost $500 following the 5-for-1 split. Nearly 70 million shares had changed hands by 1 p.m., 2/3 of the daily average over the past year. A similar phenomenon happened with Apple after a 4-to-1 split that took effect Monday. The iPhone maker had traded for more than $500 a share, a price tag so great it came to represent 12% of the Dow Jones Industrial Average. That fell below 3% in the price-weighted index on Monday, with Apple at around $125 a share. Apple shares gained as much as 4.2% to $130 Monday, while Tesla added as much as 12%, and their shares are selling for $497. Evercore ISI analyst Amit Daryanani, hopefully I said that right. I've been practicing. I couldn't get it. Sees the narrative for Apple getting better as the year progresses, helped by multitudes of tailwinds that include strong demand for its phones, as well as laptops and tablets as schools restart and consumers upgrade to newer devices. I mean, we're all on our devices these days in order to communicate. So it would make sense that we are going to need new tablets, computers, phones. Tesla, if you're a listener to the podcast, you know I have a slight obsession with Tesla. It's a really different story. The next major catalyst for shares will be its much anticipated Battery Day on September 22nd, followed by third quarter delivery figures. Online trading, this was such a big deal today that, well, I'm recording this on Monday, so looking a little bit behind the curtain there. Online trading platforms were reportedly experiencing outages on Monday, on the day the stock split. Postings on Twitter indicate technical issues with Charles Schwab, E-Trade, Vanguard Group, and Robinhood. Sounds like the big boys are making their moves first and everyone else has to wait. LOL, one commenter tweeted. Down Detector listed more than 2,900 problems from Robinhood and more than 7,000 for TD Ameritrade. We apologize for the login and latency issues with our website. These issues have been corrected, TD Ameritrade said on Twitter. Many clients are experiencing high levels of slowness on the TD Ameritrade web platforms and the TD Ameritrade mobile app. We are working to address the issue as quickly as possible, TD Ameritrade said on Twitter. Joe Saluzzi, partner and co-head of equity trading at Themis Trading, told MarketWatch that he has observed a wave of Tesla and Apple shares changing hands, and he wondered whether this could be causing some problems with various online tradings. It's an enormous amount of volume. You can't even blink. They're going through, he said. MarketWatch said a Twitter handle associated with P.J. Matlock, chief executive of Atlas Trading in New Jersey, said that Vanguard, Charles Schwab, and Robinhood were experiencing issues. So this is such a monumental event that trading apps are crashing left and right. And my boy, Elon Musk, is now the third richest person in the world, at least for right now. Musk passed Facebook co-founder Mark Zuckerberg Monday as shares of Tesla Inc. continued their unrelenting rally after undergoing a forward stock split. As of 11:25 a.m. on October 31st, Musk was worth $111.3 billion compared with $110.5 billion for Zuckerberg. And that's according to the Bloomberg's Billionaires Index, which is updated at the end of market day. Musk has seen a meteoric rise in his wealth, with his net worth growing by $76.1 billion this year as Tesla shares surged more than 475%. Also helpful is an audacious pay package, the largest corporate pay deal ever struck between a chief executive officer and a board of directors that could yield him more than $50 billion if all goals are met. Last week, the Tesla CEO joined Zuckerberg, Amazon.com Inc.'s Jeff Bezos, and Bill Gates in the rarefied centibillionaire club as tech stocks surged. The heady pace of wealth accumulation in recent months is in stark contrast to the state of the global economy. Growth has slumped sharply since the pandemic began, with companies laying off millions of workers and consumer demand cratering. The brunt of the economic pain has been borne by young and lower wage workers, whose jobs are typically more vulnerable to COVID-related layoffs. But, at the end of the day, Musk still has a long way to go to become the world's richest person. Jeff Bezos is worth around $200 billion. And again, his net worth has increased substantially since the pandemic began. So, as I've been saying, the rich keep getting richer. But it's fascinating to watch. It kind of reminds me of history class when we studied the robber barons of the 1920s and 1930s who had all this wealth. I mean, Andrew Carnegie and J.P. Morgan really had a concentration of wealth. And instead of utilities, now we've got the tech sector who has held on to all this wealth. So at the end of the day, we've got these two major stock splits. But, in my opinion, I'm not really all that impressed. Fractional shares are widely available at brokerages. I own some fractional shares. It's pretty common now. It is much more affordable, and it's even easier than splitting your stock. If a stock costs you $1,000, you can buy half, you can buy a tenth, or even a 300th of it. It doesn't matter. You can buy whatever you want. You can place $1 on any stock out there if you've got the right brokerage. But at the same time, splits aren't entirely useless. They give you a persona of confidence, and you can really trust the company that's splitting their shares. In July, Tesla posted its first full year of profit, and Apple had its strongest second quarter ever. So if we're using that as any indicator, they're pretty confident in what they've got going on. It's really just a mind game for investors. When I was a kid, and I would rather have 4 $5 bills than one $20 bill because, I felt richer. My wallet was fatter. It was nice. But, investors feel the same way. If I can have 5 shares of a company instead of 2, I feel like I'm a bigger investor. The other thing that we can't really discount is the fact that stock splits make news. And longtime listeners of this show will know that I've talked about the Tesla and Apple splits ad nauseum. Again, I think it's fascinating. If you think I need to move along, just hit me up on Twitter and let me know. But it's fascinating to see how these companies are expanding, and, they're in the news, they're making a lot of profits. It's something to talk about. So, but that's not really the whole story. Speaking specifically about Tesla, Forbes noted in a recent article that there are 3 issues that may come from the stock split. First is that the price to earnings ratio is insanely and ridiculously, their words, high. At 1,100. Come on now. The forward P/E based on something called expected earnings is a mere 140. But how much more reasonable is that, really? Tesla's multiple of 1,100 suggests investors believe that Elon Musk will be bringing back gold from his mines on Mars by sometime next year, and that the value of the metals will be showing up on the company's bottom lines right away. That's not to say that price to earnings ratios are the key to investing. It's just one thing that Forbes thinks is important, and it's one of many variables that people use to determine. But it's one of the classic ones used by Benjamin Graham and Warren Buffett. So it's smart to keep an eye on it. The second thing is the competition. Tesla it's a leader, but that doesn't mean that there aren't people that are close on their heels. High-end and middle-brow electric and hybrid and gas electric powered vehicles can be purchased from a number of established car makers. Ford, General Motors, and Honda are involved. Those taking a direct aim at the firm Tesla grip on the luxury market also include Porsche with the Taycan and Lexus with their ES hybrid. While Musk has created the name brand that seems to most clearly identify newness and style, history tends to demonstrate that others eventually take on and meet the challenge of offering marketable alternatives to the original concept. Some Tesla investors have difficulty even comprehending the idea of actual competition to their favorite highly profitable portfolio addition. It may take months or years, but highly competitive operations are underway to grab that share away. And the third thing is the hot stock syndrome. If you've been around for a few years, you've seen this before. During the most heated phase of a bull market, one stock becomes so highly recognized as the hottest one that everyone you meet knows it by name and the basics of its story. And right now, that's Tesla. Inside the Wall Street community and outside, it's the growth stock to end all growth stocks, since it just keeps going up. 470%? That's crazy growth. Analysts are pressured to include it among their buy recommendations so as not to be left behind. Robinhood traders, many of them new to the stock market and to trading, find in Tesla their dream of apparently endless profits. They have yet to experience the other side of a bull market and confidently go in with much less caution than might be merited. On the arrival of Tesla's 5-to-1 stock split, it's probably wise to take these factors into consideration. Can it keep going up in price despite all this? It can. And hot stocks do continue upward despite a lot of obstacles until they don't. So, with that, I'm going to take another quick commercial break. And when I get back, I am going to take a deep dive into the China-US trade war and what that means for you. And if you stick around to the end of the show, I am going to blow your mind with 10 of the most iconic American companies that are actually held by Chinese conglomerates. Stay tuned.
Tired of searching the vast jungle of podcasts? Now listen close and hear this out. There's a podcast network that covers just about everything that you've been searching.
Hey!
The Golden State Media Concepts Podcast Network is here. Nothing less than a podcast bliss with endless hours of podcast coverage. From news, sports, music, fashion, cooking, entertainment, fantasy, football, and so much more. So stop lurking around and go straight out to the Golden State Media Concepts Podcast Network. Guaranteed to fill that podcast itch. Whatever it may be. Visit us at www.gsmcpodcast.com. Follow us on Facebook and Twitter, and download us on iTunes, SoundCloud, and
Welcome back. Thanks for sticking with us. In our last segment, we looked at a more narrow view of what's going on this week on Wall Street by taking a look into the Apple and Tesla split shares. You have to be careful the way you say that. But I wanted to pivot just a little bit and look at what's going on between the U.S. and China. It's been in the news. It's one of the subjects that is going to be a deciding factor for so many people that are looking to vote this election. So I want to make sure that I'm educated, and I want to make sure you're educated about it. So let's look at it. The U.S.-China trade war is an ongoing economic conflict between China and the United States. President Donald Trump in 2018 began setting tariffs and other trade barriers on China with the goal of forcing it to make changes to what the U.S. says are unfair trade practices. Among those trade practices and their effects are growing trade deficit, alleged theft of intellectual property, and forced transfer of American technology to China. In response to U.S. trade measures, the Chinese government has accused the Trump administration of engaging in protectionism. On January 15th of 2020, the two sides reached a Phase 1 agreement, but that was not the end of the story. As far back as the 1980s, Trump has advocated tariffs to reduce the U.S. trade deficit and promote domestic manufacturing, saying this country was being, quote, ripped off by its trading partners. Imposing tariffs became a major plank of his presidential campaign. A backgrounder by the Council of Foreign Relations said that while many economists and trade experts did not believe that the trade deficits hurt the economy, others believed that sustained trade deficits were often a problem, and there was a substantial debate over how much of the trade deficit is caused by foreign governments, as well as what policies, if any, should be pursued to reduce it. Nearly all economists who responded to surveys conducted by the Associated Press and Reuters said that Trump's tariffs would do more harm than good to the economy of the United States. And some economists advocated for alternative means for the United States to address its trade deficit with China. The trade war, at the end of it, has affected both the economies of the United States and China. In the United States, it's led to higher prices for consumers and financial difficulties for farmers. In China, the trade war contributed to a slowdown in the rate of economic and industrial output growth, which had already been on a decline. Many American companies have shifted supply chains to elsewhere in Asia, bringing fears that a trade war could lead to a U.S.-China economic decoupling. In other countries, the trade war has also caused economic damage, though some countries have benefited from the increased manufacturing to fill the gaps. It has also led to stock market instability. And like I said in our last segments, things are up and down and they are changing so rapidly. It's an incredibly unstable time on Wall Street. Governments around the world have taken steps to address some of the damage caused by the economic conflict. Internationally, there's been support for the end goal of the Trump administration's trade war of trying to change China's trade policies, while there's also been criticism of the use of tariffs and trade wars' negative economic impact. The Trump administration is touting the U.S.-China Phase 1 trade deal's dispute settlement and enforcement mechanism as the major difference between the 86-page agreement unveiled last January and past pledges by Beijing to change its trade practices. But the final result of any dispute that prompts new U.S. tariffs to be slapped back on Chinese goods could tear the whole trade deal apart. According to the text on the agreement that was released back in January, U.S. Trade Representative Robert Lighthizer insisted on a strong enforcement mechanism with real teeth to hold China to its Phase 1 pledges to protect American intellectual property, curb the forced transfer of U.S. technology to Chinese firms, and to boost purchases of U.S. goods and services by some $200 billion over the year. And, I mean, let's note, this is pre-COVID, or pre-COVID in the United States. I think COVID was pretty rampant back in China in January, but it had really yet to impact U.S. manufacturing. So the teeth in the mechanisms are a familiar Trump administration tool, the imposition of tariffs in proportion to damage caused by any non-compliance. But according to the text, if the offending party disagrees with such a result, its only recourse is to quit the agreement. You can't appeal it. You can't levy retaliatory tariffs. You're done. So it's not a great alternative. There's no meeting of the minds here. If the party complained against considers that the action of the complaining party was taken in bad faith, the remedy is to withdraw from the agreement by providing written notice of withdrawal to the complaining party. That's it. A Trump administration official said that bad faith and good faith were undefined in the agreement, but actions would be based on facts and economic impact. Under that scenario, an enforcement action could cause the agreement to collapse, according to Chinese trade experts. Some other U.S. trade deals, such as the new U.S.-Mexico-Canada agreement, employ third-party arbitration panels to settle disputes. The Phase 1 enforcement mechanism is very simplistic. It's basically a 1 or a 0, an on or off, according to Scott Kennedy, who's an expert on Chinese economics at the Center for Strategic and International Studies in Washington. One side will risk scuppering the entire thing over an implementation dispute, he added. On August 15th, officials were expected to hold a video conference for the 6-month anniversary of the trade deal's entry into force as the coronavirus pandemic began spreading globally. As I covered in an earlier episode of the pod, this didn't happen for one reason or another. We don't even know. But there's a lot on the table as we're sitting here. The Chinese government has made a concerted effort by their economy to play a little nicer with the U.S. and American companies they rely on for economic survival. That, according to the Daily Proof newsletter on Friday. And let's note that China has not met all of the requirements that they were to have met by the 6-month anniversary of the signing of the treaty. So, but again, what do? Do we scrap it and say, okay, we're done, we're walking away? I don't think that's prudent in this situation. So right now, we're kind of in an area where no one's really sticking to the letter of the agreement, whether that's caused by complications from the coronavirus or whether that's intentional. I'm not going to say. I'm going to leave that up to you to make that decision. But the Daily Proof newsletter says that there is a struggle within China between the nationalist hardliners who want to punish the U.S. and the central government who realize that the economy needs U.S. businesses to operate in their country or face decades of economic weakness, like North Korea, for example. So what do we do with that? And how do we move on? This evidence comes from an article in the South China Morning Post. Hardly a mouthpiece of the Communist Party of China, but surely one with a critical eye on what's happening up north in Beijing. Beijing has not yet announced any measures to hit back against the August 17th worldwide curbs against Huawei subsidiaries. China said 15 months ago it would create its own entity list of foreign individuals, businesses, and organizations that pose a threat to the country and would be sanctioned, just as the U.S. Commerce Department's entity list has done with more than 50 Chinese firms this year alone. To date, Beijing has yet to produce its version of the list. Dan Wang, an analyst at consultancy Gavical, said the August 17th final rule by the Bureau of Industry and Security at the Commerce Department was akin to a death sentence for Huawei. Huawei is an important company, but Beijing is engaged in an aggressive campaign to sweet-talk big American firms to stay in China. Wang was quoted as saying by the South China Morning Post, it still needs American technology, and it needs U.S. business as an ally in its effort to temper the hostility of the U.S. government. Instead of tit for tat, Beijing will likely stand down in the hopes that former Vice President Joe Biden wins. This could be wishful thinking, though, as Biden is unlikely to be in full charge of his foreign policy. Some members of his China team, including Jake Sullivan, is pretty hawkish on China. And any moves to back down on Huawei would be seen as weak, especially given expectation by Wall Street that a Biden presidency would roll back a number of tariffs. Ding Shuang, chief economist for Greater China at Standard Chartered Bank, told the Post that Beijing's priority was to keep as many foreign businesses in the country as possible to slow decoupling. China should not overreact and must calculate its potential loss before doing anything, Ding says. The time is not ripe yet for China to publish an unreliable entity list, as it would only escalate retaliation from the U.S. The move would bring a far-reaching impact, Ding says, adding that if Trump wins, it may become an option in an attempt to bring pressure on multinational American firms, who will thus bring pressure on the president through members of Congress. So I should probably add just a regular segment on TikTok, but because something comes up every time I sit down to record my pod. This time, it's manifesting the real-life consequences of this U.S.-China trade war. So shares of Walmart were down 2.44%, and shares of Microsoft fell 1.54%, enough to pace the Dow Jones Industrial Average, pre-market decliners. Why? Because China moved to tighten technology export rules, and that's going to make the potential acquisition of TikTok all the more difficult. Walmart's stock dropped 1.9% and Microsoft shares shed 1%. The implied price declines would shave roughly 32 points off the Dow's price, while Dow futures edged up 2 points. China unveiled Friday export restrictions covering such computing and data processing technologies as text analysts, content recommendation, speech modeling, and voice recognition, saying technologies on the list can't be exported without a license from local commerce authorities. This is clearly directed at slowing down ByteDance's deal negotiation in this game of high-stakes poker, wrote Wedbush analyst Dan Ives in a note to his clients. With TikTok's key algorithm at play, ByteDance and TikTok will likely now need to go through a licensing procedure around the need to transfer software code from China to the U.S. Walmart and Microsoft were reportedly teaming up to make a bid change in export control rules, has made AI interfaces such as text and speech recognition, analyzing data, and making personalized recommendations into matters of national security. Government approval is needed for transferring and exporting the technology. CNBC reported that TikTok's sale of its operations in North America, Australia, and New Zealand could still be finalized by Tuesday of this week. Once finalized, ByteDance is likely to seek approval from the Chinese government. Microsoft, along with Walmart or Oracle, is likely to get the deal. The value of the deal is likely to be $20 to $30 billion. Kevin Mayer resigned last week as CEO of TikTok. Current CEO Vanessa Pappas said that due to e-commerce tools present in the social media app, there is a synergy between Walmart and TikTok. Walmart is also interested in the app to strengthen its e-commerce division. And I'm going to take a quick break. And when I come back, we are going to get into our top 10 list. And this week, my top 10 is going to be the top 10 iconic American companies that are owned by Chinese conglomerates. So stay tuned.
Do you work in the world of marketing and advertising? Are you a media buyer or the owner of an agency? Have you been looking for a podcast to help stay on top of all the goings-on of those worlds? The GSMC Marketing News Podcast is dedicated to keeping you up to date on all things concerning marketing and advertising. Get the latest marketing news, from what major businesses have planned for the coming year to the newest trends in advertising, from podcasts, digital and streaming, to the old standbys of radio, television, and billboards. The GSMC Marketing News Podcast has you covered, whether you're a
Okay, welcome back. Thank you for sticking with us. In our last segment, we talked a little bit about the U.S.-China trade war. And honestly, I think I'm just scratching the surface here. I think there's so much more for us to look at to really get a good appraisal of the whole situation. So I'm going to be focusing a little bit more into this in our coming episodes. So just stay tuned. And again, as always, if you have any insight that you can offer me, find me on Twitter at GSMC Financial News Podcast, and let's talk about it. So because we're talking about China's influence on the United States, I wanted to take a look at top 10 iconic American companies that are held by Chinese conglomerates. You know, I had a social studies teacher in 9th grade, and this is like 1991, 1992. I'm old, I know, I get it. But 30 years ago, Mr. Lee told us that if we wanted to get ahead in business, we should learn Chinese. I think it was Cantonese. But he was really able to see how the Chinese economy would strengthen and have ties in the non-communist world. Granted, this was in the midst of the fall of communism, but I really think that he understood things that few did. Chinese companies now own part of, or all of, a number of companies that impact American lives on a daily basis. And most people don't even really know. Whether you're going to the movies, washing your clothes, or preparing dinner, there's a good chance that some of the money that you spent to do so eventually got back to China. So here's a look at some of the bigger businesses that are owned by Chinese companies. At number 10, we have AMC. I haven't been to the movies in a long time. And I guess the movies are back in business. There's that Christopher Nolan movie that I want to see, but yeah, I'm not ready to go to the theater yet. But the AMC movie theaters are the nation's largest chain, and it was bought by Dalian Wanda Group in 2012 for $2.6 billion. The American cinema operator, who has over 8,200 screens in their 661 cinemas across the U.S., was acquired by Chinese businessman Huang Jielin, who reportedly has a penchant for Hollywood. Wang has also bought a major film studio. And in 2017, AMC added Carmike Cinemas to its holding for $1.2 billion. Jielin also tried to buy a controlling stake in Paramount Pictures last year, but parent firm Viacom rejected the offer. At number 9, we have Smithfield Foods. They're the world's largest pork producer, and it was acquired by China's Shankui International in 2013 from American owners for nearly $4.7 billion, making it one of the biggest purchases of an American company by a Chinese firm. The Virginia-based Smithfield's Food is another icon in American homes for its meats products, like its famous bacon and holiday hams. It also owns brands like Farmland, Healthy Ones, Margarita, Curly's, and Eckrich. Now, this makes me wonder, with China being the U.S.'s number 3 export market for pork and the world's largest pork producer being a Chinese-owned company, does this mean that the money just keeps going back to them? In 2017, the U.S. pork industry shipped $1.1 billion worth of pork to China, making it the 3rd largest recipient of U.S. pork. And this is all about pork that's raised, slaughtered, and processed in the United States. So we're still including a lot of American jobs here. At number 8, we have Legendary Entertainment Group. After getting the taste of show business with the AMC purchase, Dalian Wanda bought a movie studio to go with its theaters in 2016. The $3.5 billion deal put Dalian in charge of the co-financer of movies like Jurassic World, Warcraft, and Pacific Rim. Initially, the company planned to fold Legendary into its conglomerate, but decided to operate it independently for a while, until the studio can show a steady stream of profits. At number 7, we have GE Appliances. General Electric appliances have been a household name in the U.S., from refrigerators, air conditioning, stoves, washers, and dryers since 1962, with special thanks to their Made in America logo that makes their products appeal to more Americans. But what many don't know is that while GE appliances are still made in America, the iconic U.S. brand is already Chinese-owned. In 2016, GE was bought by the world's largest appliance company, Haier, from China for a whopping $5.4 billion, the largest acquisition of a foreign electronics business in China. GE Appliances are still headquartered in Louisville, Kentucky, but the real headquarters is in Qingdao, China. So I think that's interesting. Who knew? Number 5, we've got the Waldorf Astoria Hotel. If you have never been inside the legendary Waldorf Astoria Hotel in Midtown Manhattan, you need to, as soon as you can, as soon as we can travel again. It's epic. It was also, incidentally, previously owned by current U.S. President Donald Trump. But the economy has changed. Chinese investment in the U.S. economy is soaring, with such high profitable deals as China's Anbang Insurance purchase of the Waldorf Astoria Hotel in New York City for $1.95 billion. That's crazy. Chinese investment in the U.S. economy is soaring. And Anabang Insurance Group, the buyer of this well-known Manhattan hotel, and I would say a well-known Manhattan landmark, was unknown back in 2014 when it paid merely almost $2 billion for the hotel. But now it's more of a common name to investors buying U.S. insurer Fidelity and Guarantee Life back in the fall of 2018 and attempting to buy Starwood Resorts only to lose out to Marriott at the last minute. Despite that high purchase profile, it's one of the more mysterious Chinese acquirers, as the leadership at the company is unclear to outsiders. The company told the Wall Street Journal it's owned by more than 30 corporate investors, but there's really no proof of that. Anabang's interest in the hotel sector wasn't limited to the Waldorf and Starwood. Last year, Blackstone Group sold its line of luxury hotels to the Chinese company for $3.93 billion, roughly $6 billion, including the debt. The deal put Anabang in charge of 16 properties, including assorted Ritz-Carlton locations in California, the Fairmont Scottsdale in Arizona, and the Four Seasons Resort in Jackson Hole, Wyoming. At number 4, we've got Riot Games. League of Legends is one of the biggest titles in the video game world and is responsible in part for the boom in esports of the past 8 years. It's a billion-dollar franchise, but creator Riot Games started as an independent game developer. In 2011, though, Chinese holding company Tencent bought a majority stake in Riot for $400 million, and in 2015 bought the rest of the company for an undisclosed amount. Tencent also holds investment stakes in Activision Blizzard and Gears of War creator Epic Games. At number 3, we have Ingram Micro. Ingram Micro's name may be a bit less familiar to consumers, but the company distributes everything from Apple's iPhone to Cisco's network equipment. Last year, China's HNA Group, the same group that bid on Forbes, bought the company for $6 billion. When the deal was finalized in December, it ended public trading of Ingram shares, but the company remains headquartered in Irvine, California, with the same CEO. At number 2, we've got Motorola Mobility. Motorola was an early leader in the telecommunications space dating back to 1928. As mobile devices began to dominate the industry, it spun its handset division into the independent Motorola Mobility, which was bought by Google in 2012. 2 years later, though, the search giant announced it was selling the unit to China-owned Lenovo for $2.9 billion, making Lenovo the world's third largest smartphone maker. I will say, my stepkids have Motorola phones, and those things can last. So I don't think this partnership with Lenovo is necessarily a bad thing by any means. Chinese conglomerates have been buying stakes in U.S. companies and real estate for several years. Part of the problem this administration has with China is that they're scooping up companies left and right. At number 1, we've got Teledyne Continental Motors and Matatuck. This is a huge employer in my area, and I wanted to make sure that I gave them a special place on this list. Continental Aerospace Technologies, Continental Motors, and Teledyne Matatuck Services was sold to Chinese state-owned Aviation Industry Corporation of China, AVIC, for $186 million. While the American aircraft engine manufacturer is now owned by the Beijing-based AVIC, who is ranked 159th in the Fortune Global 500, it remains to be located at the Brookley Aeroplex in Mobile, Alabama, as part of the deal. So again, they've really made a pretty large investment in the local area. Chinese firms also fully owns Triple H Coal, GM Global Steering, First International Oil, Fried Goodman United, Woodbine Acquisition, Bank of East Asia USA, International Lease Finance Corp., AppTech Laboratory Services, Complete Genomics, Zonair Medical Systems, ASSA Properties, One Chase Manhattan Plaza, A123 Systems, Mochi Media, Quorum Systems, Gross International, and the PC business of IBM are also owned by China. So we are really living in a global economy. Of course, I can't go through a segment on Chinese-owned businesses without mentioning TikTok. But, you know, it can't all be about TikTok. But, you know, the reason why I wanted to do this segment isn't for some jingoistic attempt to keep China out of the American economy. It's really the opposite. It shows how we live in a truly global economy. And it's really imperative that we understand this. It's also important that we stick by our word. If we have a trade agreement with another country, that it's thoughtful and well-reasoned. Other countries will know what we mean when we say, that we'll mean what we say when we make agreements. And this is where the truth matters. So I think it's time for me to end today's show. I've enjoyed taking a deep look into the U.S.-China trade dealings. I've learned a lot, and I hope you have too. Until next time, please find us on your favorite podcast app. Subscribe and give me a nice review. It really helps. Also, find me on Twitter at GSMC Financial News. Let me know what you think of the show. And don't forget to wash your hands and wear a mask. See ya.
You've been listening to the GSMC Financial News Podcast, part of the GSMC Podcast Network. You can find this show and others like it at www.gsmcpodcast.com. Download our podcasts on Apple Podcasts, Stitcher, SoundCloud, and Google Play. Just type GSMC into your favorite podcast app to find all of the shows from the GSMC Podcast Network. From movies to music, from sports to entertainment, from business news to weird news. Please subscribe to the podcast and follow us on Twitter and Facebook. Thank you, and we hope you've enjoyed today's podcast.